How to select strike prices for credit spreads. Are you curious about how to choose the right strike prices for credit spreads in options trading? Let's break it down step by step to help you make informed decisions. Selecting strike prices is all about balancing potential profit, risk, and the chances that your options will expire worthless. A credit spread involves selling one option and buying another option of the same type on the same underlying asset but with different strike prices. The goal is to receive a net credit upfront and ideally have both options expire worthless, allowing you to keep the premium. First, you need to understand the type of credit spread you are using. For a bull put spread, you sell a put option at a strike price near or slightly below the current stock price and buy a put option at a lower strike price to limit your risk. On the other hand, for a bear call spread, you sell a call option at or slightly above the current stock price and buy a call option at a higher strike price. Next, consider your market outlook and risk tolerance. If you believe the stock will stay above a certain level, choose put strikes below that level for a bull put spread. Conversely, if you think the stock will stay below a certain level, select call strikes above that level for a bear call spread. The closer the short strike is to the current price, the higher the premium you will receive, but this also increases the risk of the option being exercised. Choosing strikes further out of the money reduces risk but also lowers the premium. Now, let's talk about the distance between strike prices and spread width. The difference between the sold and bought strike prices defines your maximum risk. A wider spread can increase potential profit but also raises risk. Narrow spreads limit risk but offer smaller premiums. It is also important to consider the probability of the options expiring out of the money. Select strikes where the probability of the short option expiring out of the money is reasonably high. Tools like delta can help estimate this. A short option with a delta of around 0.20 to 0.30 is often used to balance premium and probability of success. When evaluating the premium received versus risk, ensure that the net credit justifies the risk you are taking. Calculate your maximum loss, which is the difference between the strikes minus the net credit, and make sure it fits your risk management rules. Time to expiration is another key factor. Shorter expirations benefit from faster time decay, which helps the spread become profitable sooner. Your strike selection should take into account how much time decay you expect before expiration. Lastly, consider volatility. Higher implied volatility increases option premiums, allowing for higher credits. Adjust your strike prices to reflected volatility conditions to optimize your risk and reward. In practical terms, if you are trading a bull put spread, you might sell a put option slightly below the current stock price to collect a decent premium while buying a put option further below to cap potential losses. The same logic applies for bear call spreads in the opposite direction. By carefully selecting strike prices based on these factors, you can use credit spreads to generate income with defined risk, aiming for the options to expire worthless so you keep the initial premium collected.